84, 85 points higher for the Nifty, looking in decently strong. Mayuresh Joshi, fund manager at Angel Broking, is now joining in. Mayuresh, good afternoon. Thank you so much for taking out time for us. Last 4-5 days of selling pressure that we have seen on Nifty, you think a slight bit of aberration versus the valuations? I mean, valuations are now looking slightly more attractive for the overall Indian market.
Afternoon, Pankaj. Probably yes, but again, I think once we're coming out of the result season, the results have not been encouraging on any count. So again, I think no expectations are laid out in terms of how earnings recovery will pan out, and largely it's getting factored in as the first half of FY17 that you might see some amount of growth taking place. Add to that, I think the delay in the capex investment cycle. I think they're well-known themes probably for the markets to factor in. However, I think the global situation is something that one needs to keep an eye on. What kind of Chinese data probably comes through the Fed rate hike, which is more or less now evident that it would happen in December. And again, I think the kind of actions that we're probably seeing in Japan, I think clearly pointing out to a recessionary environment out there. So clearly, I think we're expecting a range-bound mood for the markets, 7,500, 8,200, and largely, I think even at the current levels, it is factoring in the kind of weak corporate numbers that we are probably building in from an FY16 perspective.
You think the weak global environment that you just spoke about, isn't it factored in the market, considering that we are growing at decent pace, we have now volume, we have a better, a government that the markets would want? Don't you think markets are factoring in the worst?
I think we've got a stable government in place which is reform oriented. They are doing the front-end and capex already for the better part of this year. So I think the results will start getting more prominent from the second half of FY16 or the first half of FY17. And secondly, I think even if you look at the internal consumption, I think we're still an internal consumption-led economy. So I think we're better off on both these counts, and our currency is extremely stable at this point with kind of forex reserves of close to $355 billion that we've got, giving sufficient import cover. So on all these three aspects, probably India stands out. But again, I think if you're looking at a re-rating of the markets, I think consistently you should see earnings come through, which you're not expecting. That's point number one. Point number two, probably in terms of reforms, I think what probably happens in the winter session of Parliament with relation to GST, with land acquisition, with the bankruptcy law. I think all these three bills are very, very important as a step going forward. So clearly, I think what happens with these key bills is going to be a key deciding factor. But again, I think if it fails miserably, like the last session round, I think the markets might just drift lower. So again, I think that overhang will remain on the markets. So it's going to be more stock specific in nature this time round, or at least over the next two quarters.
Right. Do you think the mid-cap space would continue to do well? As you said, markets should be stock-specific from here on. You think mid-cap markets will do better than the large-cap space, which has been the case for the last 24 months?
So clearly, Pankaj, I think the mid-cap space has outperformed, but from here on, I think you need to be really stock-specific and have a bottom-up approach. Now, very few ideas, both from an earnings growth as well as a valuation perspective, that are probably left in the market. But again, I think if one follows the strategy of having a stock-specific approach within the mid-cap universe, I think you'll make decent ROI. And clearly, I think a lot of these companies, in terms of how their share prices move, has run ahead in terms of what earnings estimates would have been estimated, at least from an FY17 perspective. So I think one really needs to have a stock-specific approach when it comes to the mid-cap universe.
Right, but do you think in the large cap space there are some opportunities? I mean, okay, let's look at Dr. Reddy's. It's down about 25% from the peak. There has been some news flow regarding that. But do you think Dr. Reddy's is a good buy at current levels?
Yes, I think there has been some news flow which has caused ripples in terms of the stock price today. But again, I think if one really leaves aside these news flows and concentrates solely on what the performance has been, I think it has been an exceptional performance even in Q2. So clearly, I think the higher R&D spends, the kind of ANDA applications that it has got, are the steps in the right direction, because once these applications start coming through, you've got these high-end generic complex products which will give substantial top-line growth to Dr. Reddy's in the years to come. So I think there are investments made in the right direction, and yes, I think a couple of markets have been extremely weak for Dr. Reddy's, specifically the PACI segment, including Russia, the CIS countries, and Venezuela. But clearly, I think if you look at the overall growth, I think we're still expecting a decent 18-19% top-line growth to come through the next couple of years. I think any decline, even from the current level, because of the huge FDA overhang that the stock has with Sri Kalam plant coming under the scanner, accounting for 8 to 10% of the top line. I think any decline from these levels up to the 3,000 mark, I think over the next few months becomes a good opportunity, unless I think the news flows and the news events suggest something else. At this current juncture, I think we're still maintaining a positive view on Dr. Reddy's.
Right, but Dr. Reddy's, do you think the potential warning letter for 3 facilities, if it accelerates, that's the risk which the markets are still not factored in?
No, clearly I think the sharp fall that you've probably seen from high levels around 200, 300, right up to 400, 500 had to a certain extent factored in the kind of expectations from the letters that the FDA had issued. So clearly I think even if you look at the kind of statements within the media reports that we're probably reading into, I think we're not estimating any major EPS change to probably take place for Dr. Reddy. So I think largely it has factored in with the kind of fall that we've seen in the price.
Right. What about the other large cap space like Sun Pharma, Lupin? You think there it's the numbers problem, numbers are not getting delivered and that's why one should stay away from those names despite correction?
Clearly, Lupin did disappoint, Pankaj, in terms of the Q2 performance. And again, in terms of Sun Pharma, I think the numbers were expected to be. So I think for the better part of FY16, as the management commentary has been put out, you're not expecting any great set to come through either in terms of top line, EBITDA growth, or even in terms of the bottom line. So clearly, I think it's the FY17 story for Sun Pharma. And if one clearly assumes the kind of applications that it got on a combined scale with Ranbaxy, I think they've got a decent, strong pipeline on the generic space as well. Again, clearly, I think if you look at the normalization happening in terms of EBITDA as well as the ROEs, I think we expect that to happen in the second half of FY17. So again, Sun Pharma is not a story that can be played out for the next 2 quarters or 3 quarters. It's a story that needs to be played out from an FY17 perspective. So I think the correction gives long-term investors an opportunity to enter the stock on declines in a staggered manner, in a sustained fashion, and clearly hold on to the stock for the next 2 years. I think you will get pretty good returns on the stock because again, I think the normalizations of ROEs will be quite evident for Sun Pharma in the second half of FY17.
Right. We had a big investor today, Basant Maheshwari. He invests a lot in a lot of mid-cap companies, and he was of the view that mid-cap pharma is giving a very, very good opportunity or is looking quite good. Do you believe the delta will be made in the mid-cap pharma space because now they are growing in size and they have seen how, these big legendary companies that we just spoke about have done. So they have learned from that. Looking at that, do you think the mid-cap space would offer much more returns in terms of pharma from here on?
So clearly, again, Pankaj, I think one really needs to be stock specific within the mid-cap universe. Take, for instance, Aurobindo Pharma. I think the stock has given stupendous returns, and it is more or less based in terms of how the ARV business has panned out for Aurobindo. And again, the acquisitions of Actavis and Natrol have worked in a significant fashion for them. 80% of the business comes from the formulation business. But you've seen a huge amount of spike happening in terms of where the stock was and where the stock is at the current juncture. So yes, I think we have an accumulative rating on Aurobindo Pharma, assumably because I think the kind of ANDA applications, 384 to be precise, and I think 216 have got approved. So there's a huge pipeline still to get approved for Aurobindo, and there's a huge opportunity in front of them in terms of sheer dollar size. Again, I think in terms of the other pharma names, I think Ipca Labs is something that we'll be liking. The numbers in terms of financial performance was a little bit tepid in terms of both domestic formulations as well as export formulations. But again, API exports is something that held out for the company, and the company's strategy has been very clear. So I think from the low margin malarial business, at least on the domestic front, these guys are shifting over to the CNS, CVS business, which is a high margin business. Again, I think they're expecting for the second half and the first half of FY17 margins to inch up from the 10.6% mark that we witnessed in Q2 close to that 15-16% mark. So again, I think it's a margin recovery story. And again, I think the FDA facilities, if they get resolved over the next 3 to 4 quarters, I think the normalizations for ROEs, like in the case of Sun Pharma, would be quite evident for Ipca Labs in the second half of FY17 as well.
Right. We spoke to a mid-cap company of late, Nectar Life Science, and they said, they're quite small when you compare to any of the companies that we just spoke. And they were of the view that, overall FDI or FDA inspections in India have got stricter. They have increased the number of staff that they have over here. The inspections have increased. Do you think that's a big risk, or Indian pharma will take some time, but they will adjust according to new rules?
No, in fact, I think it's a very welcome move, Pankaj. I think if the FDA inspections happen on a more systematic basis, I think the compliance that the larger and the mid-cap pharma companies have, I think they'll strengthen their internal processes in a much tighter fashion. And I think the compliance that need to be followed will be adhered to. So I think clearly there will be greater compliance aspects taken care of by a lot of these mid-cap and the large-cap pharma companies, which actually avoids a lot of the fuss that we probably see in terms of the import alert bans. It's the smaller pharma companies that need to shore up their compliance requirements. So in that sense itself, I think it's a welcome move, it's a positive move generally for the pharma sector. But again, I think the mid and the large cap players are largely factoring in terms of how the compliance requirements are required to be put through, and they're better equipped in my opinion.
What would you make of the auto pack? Bajaj Auto is up 3.5%. Tata Motors has done well. Hero has done well. Maruti never falls. You think the sweet spot in the auto pack continues?
So again, festive season has been good, and if you look at the numbers that Hero Motor posted, I think extremely good set of numbers. Maruti again has responded well to the festive season. And again, I think the pay commission report that one is really expecting by today evening or tomorrow, I think any raise thereof, I think will have some amount of impact in terms of how the volume growth will pan out, specifically for the two-wheeler segment and the four-wheelers. So within this segment itself, I think we liking Bajaj Auto clearly even from a numbers point of view, and we clearly expect that the kind of margins that they posted in quarter two of around 21.4, 21.6, I think that should get maintained. And again, I think if you're looking at volume growth, I think that volume growth should take place on the domestic side at a rate of 10%, which is higher than the industry, is what we are presuming over the next 2 years, with new launches coming through, and the premium bikes actually expected to increase both their market share as well as their margins. Again, I think on the four-wheeler side, I think I am extremely optimistic on Tata Motors and Maruti Suzuki. I think Maruti Suzuki has an excellent product mix. The entry-level vehicles, I think, are rightly placed for first-time buyers. And again, I think Tata Motors, with the kind of revamp that they've done specifically on their PV portfolio, I think that would augur well for the stock as well. So I think the automotive is expected to do well, but again, I think it's specific stocks that will be probably liking within the two-wheeler and the four-wheeler space.
Right. Just taking to Tata Motors, Mayuresh, we're getting some news flow that China Central Bank has given more stimulus. They have reduced the standard lending facility with effect from tomorrow. Tata Motors, of course, derives more than 50% of its EBIT from there. Mayuresh, the call that you gave in terms of Tata Motors, does it factor in any major stimulus coming in the Chinese markets for growth revival?
No, in fact, I think we've kept our assumptions for the Chinese market at a very dismal level. So I think we're looking at a higher single-digit or a single-teen-digit growth in terms of volumes for China. And again, I think if you look at the ex-China effect, I think we're building in decent volume growth happening there. Again, the new launches that are expected to take place, the modular platform strategy that Tata Motors has devised, I think are steps in the right direction. So again, on the EBITDA front, specifically for JLR, I think we have moderated our margin views, and specifically we're looking at margins anywhere between 13-14%. Now this largely factors in a lot of degrowth that comes from China. It also factors in to a certain extent the kind of depreciation and launch expense that one is talking about, which will affect the bottom line specifically for JLR. But again, I think on the domestic scale, I think MHCV segment has held up for Tata Motors. The PV segment, as I'm saying, I think that responses have been quite good for both Zest and Bolt, and again I think expecting few new launches to come through. So on a consolidated basis, I think we're expecting Tata Motors to really do well. From the current levels, I think the risk reward might be a little bit lesser, but if the stock corrects from the current levels, I think it becomes a good opportunity for long-term investors to start chipping in a very staggered manner over the next 2 to 3 months.
Right. What do you make of the aviation space? Do you like Interglobe Aviation? It's now almost close to $7 billion in terms of market cap.
So clearly, I think at the time of the IPO, I think we had a clear subscribe at the higher end of the band, and our thesis was with the kind of young fleet size it's got, I think the maintenance and operating expenses are extremely low. With the kind of operations it's got, specifically in terms of operating leases, I think, and the kind of sale and lease back profits that they generate, I think the maintenance costs also remain extremely low for the airline. ATF price is expected to stay within this lower range between 40 and 55, and that clearly augurs well for a lot of these stocks, because a major component is ATF expenses. Clearly, I think profitability has been the cornerstone for Interglobe Aviation, and again, I think the management has been very, very clear in terms of driving profitability. The concerns related to dividend payouts, again, the management is very clear that it will take the right steps to reward shareholders. Again, I think float is an issue with Interglobe Aviation. However, I think investors holding on to the stock should continue to hold on. And even on the other aviation stocks, I think the ATF pricing will have a positive effect. And though I think they've got a negative net worth in terms of how their balance sheet is looking, clearly I think over the next 2 quarters with load factors improving, these stocks will remain positively perched. So I think again, not expecting or ruling out moves on Jet or SpiceJet either. But again, I think one really needs to be cautious. So within the space itself, I think it's a clear hold on Interglobe Aviation.
Right. As far as the other aviation pack is concerned, do you think the way to look at it would be that Interglobe trades at this valuation, which is the sector leader, market cap leader, as well as market share leader? So Jet or SpiceJet or any other aviation company should list at that, should also trade at that particular space, or would that be an incorrect comparison?
No, again, I think you cannot have comparisons or parallels drawn on how Interglobe is trading. Interglobe is trading as expensive valuations at the current juncture. So I think it's more a story on how crude pricing will play out, how load factors will play out, and what kind of cash flows get generated in the business. It's a very highly cyclical business, Pankaj. And again, I think one really needs to understand that one needs to play the cycle very, very correctly for this industry. I think you've already seen turbulent times in terms of economic activity over the past few years playing truant on a lot of these balance sheets. So Jet, SpiceJet clearly have balance sheets which are having cash flow problems. And again, I think it will take substantial amount of time to generate cash year after year, and it's not possible for the world economy to grow at a consistent pace. However, Interglobe guys have been successfully able to manage their costs, and with that respect itself, I think they've managed to stay afloat in terms of the bottom line. So clearly, I think in terms of the next 2 quarters, I think these stocks can do extremely well. But again, I think it will be more technical in nature over the next few months rather than fundamentals taking place.
Right. Mayuresh, thank you so much for taking out time for us. Always a pleasure talking to you. We are taking a quick break. Markets have extended on 2 gains, 95, 96 points higher for the market. So at least in the first half an hour of the 230 factor, we've not seen any major sell-off come into the market. In fact, we are almost close to the day's high. Taking a break, coming back into last